world is screaming Palantir is the future, turn on CNBC, scroll through your favorite investing subreddit, check the comments on any finance YouTube channel, and you'll see the same refrain repeated like a mantra. Palantir is going to revolutionize government. Palantir is going to dominate enterprise AI. Palantir is the next mega-cap tech giant in the making. Buy now before it's too late. The FOMO is palpable. The enthusiasm is infectious. And the crowd is absolutely convinced that this is the next trillion-dollar company that will mint millionaires for early investors. But I'm here to tell you something different, something you probably don't want to hear but desperately need to understand. Be very, very careful. I've been investing for over 60 years. I've seen bubbles inflate and pop. I've watched fortunes get made and lost. I've witnessed countless companies get labeled the future only to become cautionary tales in bankruptcy filings. I remember 1999 vividly, when every internet company was supposedly going to change the world and make investors rich beyond imagination. Most of them are dead now, their shareholders wiped out, their stock certificates worth less than the paper they were printed on. I remember 2008, when housing and financial engineering were the future and people thought prices could only go up. We all know how that ended. Often, probably more often than not, the future turns out to be a terrible investment even when the underlying technology or trend is real. The future of the internet was real in 1999, but that didn't stop 90% of internet stocks from going to zero. The future of housing and homeownership was real in 2006, but that didn't prevent the worst financial crisis since the Great Depression. So yes, Palantir might very well be part of the future of AI and data analytics. I'm not disputing that possibility, but that doesn't automatically make it a good investment. In fact, at current prices, I believe it might be one of the worst investments you could make, a trap that will ensnare well-meaning people who confuse a good company with a good stock. Let me analyze why I believe Palantir is a trap you should stay away from. I've identified 17 specific, concrete reasons that should make any rational investor pause and reconsider before putting hard-earned money into this stock. Let me start with what I consider to be one of the most egregious and wealth-destroying practices in all of corporate America: shareholder dilution. Palantir is what I call a dilution machine. They print shares like the Federal Reserve prints money, endlessly, relentlessly, without shame or apology. The outstanding share count has ballooned over the years at a truly alarming rate. We're not talking about small numbers here. Every single quarter, millions upon millions of new shares are created and handed out to employees, executives, and insiders. And here's what that means for you as an outside shareholder. Every new share makes your share worth less. Think about it like a pizza. You buy a slice of a pizza that's been cut into 8 pieces. You own 1/8 of the pizza. Then the restaurant decides to cut the same pizza into 16 pieces. You still have 1 slice, but now you own 1/16 of the pizza instead of 1/8. The pizza didn't get bigger. You didn't get more pizza. Your slice just got smaller. That's exactly what's happening to Palantir shareholders every single quarter. The company isn't growing its intrinsic value fast enough to offset the dilution, so your ownership percentage is shrinking while you watch helplessly. This is what I call the silent killer of returns. It doesn't show up as a line item that grabs headlines. The stock price might even go up in the short term if there's enough buying pressure and momentum. But underneath, your actual stake in the company is eroding like a sandcastle in the tide. Over 5 years, 10 years, the cumulative effect is devastating. You could see the company's value double and still lose money if the share count also doubles because your percentage ownership stayed flat while the price went up. The numbers are staggering when you calculate them. If Palantir dilutes shareholders by 4% annually, which is conservative based on their patterns, that compounds to a 33% loss of ownership over 10 years. You invest $100,000 today, and 10 years from now, you own the equivalent of $67,000 worth of the company before any value changes. The company's value needs to grow by 50% just for you to break even after dilution. This isn't investing. It's running uphill on a treadmill that keeps getting steeper. Now let's talk about management, specifically the CEO. Alex Karp is certainly a character. He's eccentric, philosophical, outspoken, and very loud. He gives rambling interviews about civilization and authoritarianism. He positions himself as a deep thinker, wrestling with moral questions. He makes headlines and creates buzz, and that's exactly the problem. I prefer the quiet operator. Leaders like Tim Cook at Apple, who let products speak. Leaders like Ajit Jain, who runs our insurance operations with brilliant precision and zero celebrity interest. Leaders who show up, focus on operations, allocate capital wisely, and deliver results without needing applause. When a CEO is a celebrity, spending time on book tours and television appearances, watch your wallet carefully. The focus shifts from running the business to managing personal brand. Decisions get made to generate headlines rather than shareholder value. The CEO becomes more interested in legacy and reputation than in the unglamorous work of improving margins and compounding capital. I've seen this movie many times. The celebrity CEO almost always destroys shareholder value while enriching themselves. The focus should be on the business, not the persona. You want a CEO who wakes up thinking about making the company worth more, not about their next media appearance. You want someone obsessed with details, numbers, operational excellence. Karp is brilliant, sure. But brilliance in philosophy doesn't translate to excellence in capital allocation. The CEO's job is to allocate capital wisely on behalf of shareholders. Everything else is distraction. Let me address something nobody talks about seriously, but represents a massive threat: the commoditization of AI. Right now, AI feels special and magical. Every company is scrambling for AI capabilities. It's the buzzword that gets funding, press coverage, drives stock prices. Palantir positions itself as having special, premium AI worth paying millions for. They charge massive amounts because their AI is supposedly unique and irreplaceable. But history teaches us technology always gets commoditized. Always. What starts expensive and proprietary becomes cheap and ubiquitous. Look at computing power. In the 1,960 seconds, mainframes cost millions and filled rooms. Today, your phone has more power than NASA used for moon missions, costs a few $100. Look at databases, cloud storage. Within years, prices collapse as competition emerges. AI is commoditizing before our eyes. Microsoft has AI in every product. Google's been doing AI for over a decade. Amazon, Meta, every major tech company and thousands of startups are building AI tools. Open source models improve monthly. You can download powerful AI models free and run them on your laptop. Barriers to entry are dropping rapidly. When everyone has similar AI capabilities, when technology is no longer rare, profit margins collapse. Race to the bottom on pricing. Let me give you a real example. Remember when cloud storage was new and expensive? Box went public valued like they'd invented something revolutionary. everyone charged premium prices. Fast forward 5 years and cloud storage became essentially free. Google gives you gigabytes for nothing, Microsoft bundles it with Office, Amazon keeps cutting prices. Companies built on premium cloud storage pricing saw valuations collapse because the technology became commodity. The exact pattern will play out with AI analytics. Palantir is Box in 2014. In 5 years, what they do will be standard features in Excel and Google Sheets. Premium pricing evaporates overnight. Here's another risk: the ethical baggage Palantir carries. They work on controversial projects, wars and military operations, mass surveillance tracking citizens, immigration enforcement, and deportation operations. These aren't neutral business activities. They're lightning rods for protest, boycotts, reputational damage. Every few months, another article about Palantir's controversial contracts. Employees at other tech companies stage walkouts, demanding employers not work with Palantir. Universities protest Palantir recruiting. This fundamentally limits their addressable market. Thousands of companies will refuse to hire Palantir regardless of product quality because they don't want association with ethical controversies. Progressive companies won't touch them. Certain industries won't touch them. Entire market segments closed off. Reputation, once damaged, is incredibly difficult to repair. Takes 20 years to build, 5 minutes to ruin. One scandal, one data breach, one controversial operation goes public wrong way, and Palantir's brand could be permanently tarnished. I prefer companies selling products everyone can love without moral qualms. Coca-Cola sells happiness in a bottle. Nobody boycotts Coke over ethical concerns. Insurance protects people from catastrophe. Railroads move goods efficiently. These are businesses where reputation is built on quality and service, not navigating ethical minefields. Palantir chose to operate in shadows, and shadows come with risks. Now let's examine how Palantir's management allocates capital shareholders have entrusted to them. What do they do with their cash? Do they buy back stock when undervalued, returning capital to shareholders tax efficiently? No. Do they pay a dividend, giving shareholders tangible returns and proving cash generation is real? No. So what did they do? They bought gold bars. I'm not making this up. Palantir literally bought millions in physical gold for their balance sheet. A technology company buying gold like a doomsday prepper. What does that say about confidence in their own business? About ability to deploy capital productively? If you can't find better uses for cash than buying gold bars, you're either incompetent at capital allocation or don't believe your own growth story. They also invested heavily in SPACs during the pandemic bubble and lost money because, surprise, most SPACs turned out garbage. This shows catastrophically poor judgment. They're taking shareholder capital and gambling on speculative fads instead of investing in core business or returning it to shareholders. Good capital allocators are boring. They compound capital steadily through intelligent decisions. Palantir's management does the opposite. Let me introduce a concept every investor should understand: the retained earnings test. Every dollar a company retains should produce at least $1 of additional market value over time. If a company earns $1 and keeps it rather than paying dividend, that dollar should be reinvested so wisely it creates more than $1 of value. Otherwise, just pay the dividend and let shareholders invest it themselves. Palantir has retained billions over the years. Have they created real, lasting value with that capital? Or just temporary hype-driven value that evaporates when sentiment changes. Look at their return on invested capital, measuring how efficiently they deploy capital. It's weak, mediocre at best. They're not generating exceptional returns on capital. They're reinvesting. Hallmark of a mediocre business masquerading as great through marketing and hype. Great businesses generate returns on invested capital of 20, 30, 40% or more. Every dollar retained and reinvested produces multiple dollars of value, compounds powerfully, creating exponential wealth. Palantir doesn't have that. They have mediocre return profile dressed up in AI buzzwords and government contracts. When you strip away the story and look at capital efficiency, it's unimpressive. Palantir loves talking about their wide moat, their durable competitive advantages. They claim uniquely positioned with proprietary technology that can't be replicated. But when I look closely at this supposed moat, I see cracks everywhere, water leaking through. The moat is not as wide or deep as claimed. Switching costs, supposed to keep customers locked in, are lowering. Data integration technology improving rapidly. What used to require Palantir's proprietary platform can now be done with other tools, often cheaper and easier. Competitors emerging offering Palantir light solutions at half price or less. They don't have all bells and whistles, but cover core use cases most clients need. In business, good enough at half price usually wins over perfect at double price. A moat is only valuable if truly unbreachable, if competitors can't find a way around or through. If your moat is just a muddy ditch competitors can hop over, it's not protecting anything. Palantir's moat looks more like a ditch every day. Let's talk recession risk, something that should terrify anyone holding Palantir at these prices. Palantir software is expensive. Their contracts are multi-million-dollar deals, taking months to close and years to implement. In good economic times, when companies have money to spend and CFOs are pressured to innovate and leverage AI, these expensive contracts get approved. But in a recession, when budgets get slashed and every dollar is scrutinized, what happens? CFOs start asking hard questions. They distinguish between need to have and nice to have. Mission-critical systems like payroll, accounting, core operations get funded. Nice to have analytics platforms costing millions, cut first. If I'm honest, Palantir is often nice to have. Clients can survive without it. They might not optimize as well, might not have fanciest dashboards, but they can function. That makes Palantir vulnerable to first budget cuts in any downturn. Revenue could freeze completely in serious recession. New contracts dry up. Existing contracts might not renew. Sales pipeline collapses. When revenue freezes but cost structure stays high because you're paying employees an expensive stock compensation and running expensive operations, financials deteriorate rapidly. The stock, priced for aggressive growth, gets crushed when growth goes to zero or negative. Recession risk compounds with Palantir's high customer concentration in government. When budget cuts come, and they always do eventually, government agencies don't cut evenly. They make strategic decisions about what's essential. Multi-million-dollar AI analytics platform from Palantir won't be classified essential compared to actual operations, personnel, equipment, infrastructure. It's consulting service dressed as software, and consulting services are first to go in budget crunches. We saw this in 2008 and 2009. Companies slashed McKinsey and Bain contracts overnight, fired expensive consultants, made do with internal resources. Palantir would face same fate in next recession. Worse, because their stock is priced as mission-critical infrastructure when they're really expensive, nice-to-have service. Now let's examine who owns Palantir stock. The shareholder base is dominated by retail investors. People on Reddit, watching YouTube videos, trading on Robinhood with small accounts and big dreams. Nothing wrong with retail investors. But retail as a group is emotional, fickle, panics easily. They buy on hype and momentum, sell in fear when things go wrong. Institutions, the smart money managing billions with armies of analysts, are more cautious about Palantir. Some own it, sure, but they're not backing up the truck. They're taking small positions, hedging, being careful. When institutional ownership is low and retail ownership high, that's a red flag. Means sophisticated investors are skeptical and unsophisticated investors are all in. Guess who usually loses money in that scenario? When hype dies, and hype always dies eventually, the exit door becomes very small very fast. Retail investors all try selling at once. Liquidity evaporates. Stock gaps down violently. Circuit breakers trigger. Volatility explodes. People who bought at top, believing the dream, end up selling at bottom in panic, locking in catastrophic losses. I've watched this happen dozens of times across different stocks and cycles. The pattern is always the same. People aren't buying Palantir because they've done rigorous discounted cash flow analysis. They're not buying because price to earnings is attractive or dividend yield is compelling. They're buying a dream. They're paying what I call price to dream ratio, which has nothing to do with current earnings or assets and everything to do with hopeful speculation. One day Palantir will run the world, they tell themselves. One day this will be worth 10 times more. But investing in dreams is a nightmare. Dreams don't pay bills. Dreams don't compound wealth. Dreams evaporate when reality intrudes. I invest in businesses that generate real cash flow today, right now, that I can see and verify and count. Show me the cash flow today, not in some hypothetical future that may never arrive. Palantir wants you to pay for tomorrow's potential success at today's prices multiplied by 100. That's not investing, that's wishful thinking backed by money you'll probably lose. Let me circle back to stock-based compensation because this deserves another look from a different angle. Palantir can't stop the SBC. It's not a choice at this point, it's an addiction. They're trapped in a vicious cycle. They need to attract top talent to compete in AI and data analytics. The best engineers and data scientists could work anywhere. Why choose Palantir over Google or Microsoft? Because Palantir pays them in large stock grants that make them rich if the stock goes up. But here's the trap. If stock price drops, employees start leaving. The compensation package that looked amazing when stock was at $60 looks terrible at $30. Engineers get recruited away by competitors offering cash or stock in stable companies. You get brain drain, where best people leave and you're stuck with ones who couldn't get better offers. This is a reflexivity loop. High stock price equals happy employees equals retention equals continued performance equals high stock price. But it works in reverse. Low stock price equals unhappy employees equals departures equals declining performance equals lower stock price. The entire business model at some level depends on maintaining high stock price to keep employees from leaving. That's not stable foundation for business. That's a house of cards. Businesses should be built on durable competitive advantages, on products customers need, on economic moats. They shouldn't be built on necessity of keeping stock price elevated at all costs to prevent employee exodus. Here's something from my decades of experience studying thousands of companies. Complex businesses usually fail, and simple businesses usually succeed. I know that sounds simplistic, but it's been true again and again across every industry and era I've studied. Complexity is seductive makes you feel smart to understand something complicated. But complexity creates hidden risks, unexpected interactions, failure modes you can't predict. Palantir is incredibly, almost incomprehensibly complex. Long sales cycles taking months or years. Every contract requires custom implementation with dozens of variables. No two customers are same. Technology complex, business model complex, pricing complex, delivery complex. This complexity kills margins because you can't standardize and scale. You need expensive humans managing complexity. Simplicity, on the other hand, scales beautifully. Build once, sell million times, margins expand, profits compound. I'd rather own simple business I understand completely than complex business promising higher returns, but coming with unknown risks and unknowable failure modes. Simplicity compounds wealth. Complexity usually destroys it. Let me offer an alternative most Palantir investors haven't considered. Why take enormous risk betting everything on Palantir? Why put yourself where one company's execution determines your financial future? You could buy S&P 500 index fund instead. Beautiful part. Palantir is in S&P 500 now, so you'd still own Palantir, just tiny slice. But you'd also own Apple, Microsoft, Berkshire, Nvidia, Amazon, literally all 500 largest companies in America. Diversification is protection against ignorance. I've said that for years. If you're not sure which company will win, which is case for almost everyone almost all time, diversify. Don't bet farm on one horse. Spread bets across many horses and let winners carry you forward while losers don't kill you. S&P 500 has compounded at 9 to 10% annually over long run. Doubles money every 7 years. Boring, not exciting, can't brag about at parties, but it works. Doesn't blow up portfolio when one company disappoints. I love dividends, always have, always will. Dividends prove cash generation is real, not accounting fiction. When company pays you cold hard cash every quarter, you know they have the money. Can't fake dividend for long. Palantir pays 0 dividends. Not a penny. Your only way to make money is if someone else buys shares at a higher price in future. That's greater fool theory again. You're entirely dependent on next buyer being more optimistic and less informed than you. I want to get paid while I wait. Want companies generating so much cash they send quarterly checks while business continues compounding. Gives me optionality. Can spend dividends if I need income, or reinvest to compound faster. Palantir gives you none of that. All or nothing. Either stock goes up and you sell to someone else, or stock goes down and you lose money. No cushion, no income stream, no tangible return while waiting for future to arrive. High interest rates are kryptonite for growth stocks, and Palantir is definition of growth stock priced for perfection. When interest rates were 0 or near 0, future cash flows seemed incredibly valuable. Could discount them at 1 or 2%, and even cash flows 10 or 20 years in future had significant present value. But now rates are 5%, likely staying elevated for years. This fundamentally changes valuation math. Palantir's supposed value is almost entirely based on cash flows they might generate 5, 10, 15 years from now. When you discount those future cash flows back to present at 5%, they're worth dramatically less than when discounted at 1%. Valuation has to come down to reflect this reality. As rates stay high, stock price must adjust lower. We've already seen this play out across growth stocks broadly. Era of free money is over. Money has costs now. Palantir was built and priced in era when money was free. That era is gone and not coming back soon. Let's talk about corporate governance. The founders hold super voting shares called Class F stock. These shares have special voting rights, giving founders permanent control regardless of how much stock they own economically. Even if they sell 90% of economic interest, they still control company decisions. As outside shareholder with regular common stock, you have effectively zero say in how company is run. If founders want to do something crazy, you can't stop them. If they want pursuing vanity projects, destroying value, you're along for a ride whether you like it or not. I strongly prefer one share, one vote. Corporate democracy matters. Shareholders who put up capital should have say in how it's deployed. This dual-class structure is dictatorship, not democracy. You're trusting benevolent dictators to always act in your interests. History suggests that's bad bet. Finally, let me talk about patience, because this might be most important investment principle I can share. Stock market is a device for transferring money from impatient to patient. That's not metaphor. It's mathematical reality, playing out day after day, year after year, decade after decade. Palantir investors, ones enthusiastically buying at current prices, are overwhelmingly impatient. They want 10x returns in a year, want to get rich quick, want to tell friends they found next Amazon or Apple at ground floor. I am willing to wait 10 years for right opportunity at right price. We'll wait for price to come to me rather than chasing it higher. I have discipline most investors lack. And that patience, that discipline, gets rewarded handsomely over time. Right now, Palantir's price is on the moon, trading at valuations assuming perfect execution for decades. Why would I buy at those prices? I'll wait, I'll watch. If stock ever comes down to reasonable valuation where risk-reward truly favors shareholders, then maybe I'll reconsider. But right now, today, at these prices, it's not even close. Patience is ultimate edge in investing. Let me end with one final thought. The difference between successful long-term investors and those who lose money consistently isn't intelligence. It's not education. It's not access to information. Most investors today have more information at fingertips than I had for first 30 years of my career. Real difference is discipline and emotional control. Ability to say no when everyone around you is saying yes. Ability to sit on cash earning 5% when there's nothing attractive to buy, even when it feels uncomfortable watching others make money. Palantir is test of your discipline right now. Crowd is telling you to buy. Momentum screaming at you to buy. FOMO eating at you every time you see stock go up another 5%. But fundamentals, valuation metrics, competitive risks, dilution, they're all telling you clearly to walk away and protect capital. Which voice will you listen to? Voice of discipline that has created lasting wealth for generations, or voice of greed and impatience that consistently destroys capital? That choice, made in moments like this when it's hardest to do right thing, will determine whether you build lasting generational wealth or join long list of people who learned expensive lessons buying overhyped stocks at ridiculous prices. I've been doing this for more than 6 decades now. I participated in 14 different market cycles. I've seen every type of bubble, every type of mania, every type of speculative excess you can imagine. And one thing never changes. Stocks that trade at absurd valuations, divorced from fundamentals, eventually crash back to earth. Gravity always wins. Math always wins. Fundamentals always matter, even when it seems like they don't for extended periods. Palantir is defying gravity right now, riding momentum and hype. But gravity doesn't stop working just because people choose to ignore it temporarily. The question you need to answer for yourself is simple. Do you want to be holding Palantir when gravity reasserts itself? Do you want to be person who bought at top, who believed hype over numbers, who ignored warnings because everyone else was making money? Or do you want to be person who had discipline and courage to say no, to protect capital, to wait patiently for better opportunities at rational prices? History will record who made right decision, but you don't need to wait for history. Evidence is already overwhelmingly clear if you're willing to look at it honestly. Palantir is not the future of your portfolio. It's a very expensive lesson waiting to be learned by those who choose to ignore basic investment principles in pursuit of lottery ticket returns. Don't get swept up in the future. Future is uncertain. Price you pay is certain. And what you're being asked to pay for Palantir is far, far too high. Protect your capital. Stay grounded. Stay rational. Stay away. And here's what makes the dilution even worse. It's completely within management's control. They choose to compensate employees primarily with stock rather than cash. They could change this practice tomorrow if they wanted to protect shareholders. But they don't, because it's easier to issue stock than to earn the cash necessary to pay competitive salaries in the ruthless tech labor market. It's a deliberate transfer of wealth from outside shareholders to insiders, plain and simple. And it happens every single quarter like clockwork with the regularity of the sunrise. The only way to fight against this wealth transfer is to not participate in the first place. Don't volunteer to have your ownership stake systematically diluted year after year while management enriches themselves and their employees at your direct expense. Walk away while you still have your capital intact. What really concerns me about the celebrity CEO problem is that it creates misaligned incentives throughout the entire organization. When the CEO is focused on being a public intellectual and media personality, that mindset trickles down through the ranks. Middle managers start caring more about getting featured in tech blogs than about hitting their numbers. Engineers start thinking about their personal brand on LinkedIn rather than about writing efficient code. Sales teams prioritize flashy demos for press coverage over closing unglamorous but profitable contracts. The whole company becomes oriented around perception management rather than value creation. And perception management might move the stock price in the short term, but it doesn't create durable wealth for long-term shareholders. The commoditization risk extends beyond just the technology itself. Even if Palantir's specific implementations remain somewhat proprietary, the entire market for expensive data analytics is shrinking as tools become more accessible. 10 years ago, you needed a team of data scientists and expensive software to do basic analytics. Now, a business analyst with an Excel subscription can do sophisticated data modeling that would have required Palantir-level tools in the past. The march of progress makes expensive things cheap and cheap things free. Palantir is fighting against this inevitable tide, and historically, nobody wins that fight. You can delay it, you can slow it down, but you can't stop it. And when you're trading at 50 or 100 times sales, you don't have the luxury of time to figure out how to adjust your business model. I want to emphasize the gold bar situation again because it's such a perfect microcosm of the capital allocation problem. When a high-growth technology company that's supposedly revolutionizing government and enterprise decides to buy physical gold bars, that's sending a very specific signal. It's saying that management can't find productive uses for capital within their own business. It's saying they don't believe in their own growth story enough to invest in it. It's saying they're more worried about preserving purchasing power than about compounding shareholder wealth. Those are not the actions of a management team that truly believes they're building the next trillion-dollar company. Those are the actions of a management team that's hedging against their own failure. Ask yourself, if the CEO doesn't have enough confidence to invest in his own business, why should you? The retail-heavy shareholder base also creates structural problems beyond just volatility. Retail investors tend to be less sophisticated about valuation metrics. They don't necessarily understand discounted cash flow models or know how to calculate normalized earnings power. They buy on stories and momentum. This means the stock can disconnect from fundamentals for extended periods, trading based purely on sentiment rather than on any rational assessment of intrinsic value. That's great when sentiment is positive. The stock can massively outperform while fundamentals are deteriorating. But it's catastrophic when sentiment turns because there's no fundamental support to catch the falling knife. Institutional investors, with their models and their mandates and their risk committees, provide some level of stability. When a stock is dominated by emotional retail traders, you get boom and bust cycles that destroy wealth.